Hello, I'm going to read to you. This was linked in this morning's Financial Times. It's a speech given at and by the Swiss National Bank, the Central Bank of Switzerland, 16th of January 2018. Thomas J. Jordan, Chairman of the Governing Board. Ladies and gentlemen, it is a great pleasure for me to be your guest here tonight. The subject of my speech is the creation of money in our economy. Since money creation in our financial system is closely linked to the granting of loans by banks, I am going to talk about lending. I shall moreover address the issues of sovereign money and access to digital central bank money insofar as they relate to our main topic. We are all aware how profoundly the economic and monetary developments of the last 10 years have been shaped by the global financial and economic crisis. Central banks responded swiftly and resolutely to the crisis, reducing interest rates and pumping large amounts of liquidity into the banking system. Once interest rates were down to almost zero, central banks were forced to adopt unconventional measures. Against the backdrop of a dramatic appreciation of the Swiss franc, the Swiss National Bank resorted mainly to interventions in the foreign exchange market, supplemented for a while by a minimum exchange rate for the Swiss franc against the euro. Since the discontinuation of the minimum exchange rate, the SNB has charged interest, known as negative interest, on the sight deposits of banks. The aim of all these measures has been to stabilize price developments and to support economic activity. The financial crisis has had the effect of generally raising the level of public interest in monetary issues. Not least the question of how, given the strong expansion of liquidity, the interaction between central banks, banks, and the public affects money and credit aggregates. For obvious reasons, the financial crisis also spurred debate in the world of financial market regulation, with central banks and financial market supervisory authorities grappling with the weaknesses exposed by the crisis. Their conclusions are reflected in the new international minimum requirements known as Basel III, as well as in supplementary national regulations. The most important adjustments include stricter capital requirements and the introduction of international liquidity standards for banks. Some radical proposals have also gained traction as a result of the crisis. In Switzerland, the Sovereign Money Initiative attracted enough signatures to ensure a popular vote. The initiative demands that the creation of money and the granting of loans be separated by barring commercial banks from creating deposits through lending. The Federal Council, Parliament and the SNB have all come out in opposition, but the final decision rests with the Swiss electorate, who will vote in a referendum on this matter later this year. As an alternative to the concept of sovereign money, some academics have launched the idea of making digital central bank money accessible to all. This means that sight deposit accounts with the SNB would no longer remain the sole preserve of banks and few other financial market participants. The aim of this proposal is thus to broaden the public's access to central bank money without prohibiting banks from creating deposits through lending. However, as I will show, this too leaves a number of questions unanswered. We therefore take a critical stance on this proposal. Let me now turn to the basics of money creation in our present-day financial system. Money creation in today's financial system. Types of money. When speaking about money, we need to distinguish between various types of money. Especially important with regard to our topic is the distinction between central bank money on the one hand and commercial bank money, i.e. deposits with commercial banks, on the other. The two differ in terms of characteristics and risk, as well as in the way that they are created. Central bank money comprises banknotes in circulation and the sight deposits held by commercial banks at the central bank. Both are legal tender, which means that no restriction may be imposed on their acceptance. Central bank money, like all nominally denominated money, is subject to the risk of inflation, in other words, to the risk of losing value as a result of prices rising for goods and services. Apart from this, however, central bank money is practically risk-free. In Switzerland, central bank money is created by the Swiss National Bank. Whenever, for example, the SNB purchases foreign currency or Swiss franc denominated securities from a commercial bank, it credits the amount paid to the sight deposit account of the bank concerned in Swiss francs. If the SNB wants to reduce the amount of central bank money, also known as the monetary base, it can conduct transactions in the opposite direction. It then sells foreign currency or Swiss franc denominated securities to banks and charges the corresponding amount to their sight deposit accounts. The SNB is thus in a position to either increase or decrease the monetary base in accordance with its monetary policy goals. The breakdown of monetary base into banknotes in circulation on the one hand and sight deposits held by banks at the SNB on the other is determined by public demand for banknotes. If you, ladies and gentlemen, withdraw more money than usual before Christmas to do your Christmas shopping, the volume of banknotes in circulation increases, only to decrease again after Christmas when the money is taken in by the shops and flows back to the SNB via the commercial banks. Banks can, through the SNB, exchange banknotes against sight deposits and vice versa. They thus have access to both banknotes and sight deposit accounts at the SNB, while the public has access to banknotes only, since private individuals cannot hold an account with the SNB. Sight deposits are used by banks for cashless interbank payment transactions. Payments between banks or their customers are effected via the Swiss Interbank Clearing (SIC) system and result in the reallocation of sight deposits across the participating banks' accounts at the SNB. Moreover, banks are obliged to fulfill the minimum reserve requirements of the National Bank Act, i.e. to hold sufficient reserves either in the form of banknotes or as sight deposits with the SNB. Deposits with commercial banks are distinct from central bank money. When speaking of these deposits in my remarks today, I will be referring to the sight deposits, also known as demand deposits, of their customers. Customers also hold savings and time deposits with banks. These cannot be directly drawn on for transaction purposes, but they are cash equivalents and therefore included in broader definitions of money. Bank customers can use their sight deposits to make payments. Unlike central bank money, the deposits with the commercial banks are not legal tender, but they do represent a claim on central bank money. Bank customers can withdraw sight deposits in the form of banknotes, i.e. central bank money, or instruct their bank to make a cashless payment. The latter leads to a reallocation of SNB sight deposits, again central bank money, from the customer to the payment recipient's bank. From the public's perspective, cash and deposits with commercial banks are virtually the same for payment purposes. However, deposits are subject not only to the risk of inflation, but also to credit risk. If their bank becomes insolvent, customers' claims to central bank money cannot be redeemed, or can be redeemed only up to the maximum amount covered by the Deposit Guarantee scheme. It is mainly in the times of crisis that the public becomes aware of this risk. Were this not the case, there would be no runs on banks such as have been experienced time and time again in the past. Credit risk is, however, offset by a number of advantages. Unlike banknotes, sight deposits with banks provide access to services in connection with payment transactions, and in normal times they also generate a little interest income. How are deposits at commercial banks created? How do deposits at commercial banks, i.e. customer deposits in Swiss francs, come into existence? In our present-day financial system, the creation of deposits by banks is closely linked to the granting of loans. When a bank provides a loan, it credits the amount in question to the borrower in the form of a deposit in his or her account. This leads to an increase in credits on the asset side of the customer's deposits and on the liability side of the bank's balance sheet. Now, that's the end of page 4 of 12 of what hopefully you've understood is quite a nicely presented little speech. And if you've got this far, I presume that you've understood you've understood it. You've been able to translate it into castles and riders going out and saddlebanks and the big banker's book and all that sort of stuff. There should have been nothing in there that you don't understand. And this has been my aim. Because, okay, how to attack this? I knew I'd get here and do that first bit dry. 13 minutes, not too bad. It's kind of like we're alone now. I think quite a few people will have dropped out. There might be some Americans listening. It's mainly Americans that are irrational. What I've presented in YouTube videos at the website and reading this is getting across facts. Now, why are the facts important? It's because the financial crisis, has caused, I'm bored with the word problems, it's caused distortions in the outside world, outside the castle. In our world, it's caused distortions. The next thing to understand, I think, and this is where I think it's important to maintain perspective and not get excited about us and them and all sorts of weird conspiracy theories. The United States have done this. The United Kingdom's done this. This is Switzerland saying they've done it. We know that Japan's done it, and the European Central Bank has done it. Basically, most all of the Western world has done it. So if you want to have any sort of conspiracy theory, It has got to involve everybody. But I think we can say that what we have is a lot of well-meaning people that have done what they thought was the best in what they thought was a very tricky situation. And that is what we have now. And the main distortion, I'll finish here, getting on for 16 minutes. And I might talk about it more if I feel inspired, is that interest rates have been too low for too long. This has caused problems, distortions, and if I do go on, I will iterate a few of the main distortions, which it will take probably a couple of generations to get over. But I'll finish this video by saying all this banking stuff is not a problem in and of itself. They, though the central banker people, have got over big problems by doing tricky things, and it has not been free for them either. They have still got problems to get over. But we're leaving that aside, because what I'm saying is they are not particularly in trouble, and they are not going to cause us directly any more trouble. The financial crisis was a financial crisis. And these guys have done things, we can say it's helped or not, it doesn't really matter. They have done things, and the things they've done. But they are kind of over it. And there is not going to be another financial crisis because they've got unfinished business of their very own. The crisis are the ripples that go out via things like interest rates being too low for too long. That is the problem. In and of itself, the central banks really don't have what we could call critical problems. They've got to go to work, and they've really got to think about things where in the past they could probably get out and play golf at 3 o'clock and have long holidays. But now they've got to go to work and really work. But they're all right. But what they've done has created these distortions that we outside the castle have to live with. And it's important that we know what they have done and the factual things that they have done, so we know we can ignore it now to a greater extent. And if we need to refer back to it to say, think of things that we can suggest to do to ameliorate the situation of the distortions that have been caused, we understand their system better. But we can put them aside now, knowing what they do, what they've done, and it's interesting. It's always interesting to know the facts. But basically, we can put them away in a box and know that we have to live with the ripples that are going out, and they particularly aren't going to cause any more great splashes. But the ripples are well big enough that they have to be dealt with. Yep. Bye.